Hey guys, it's Chad Larson with MLD Wealth, and this is April's 2025 edition of Money Matters. Oh boy, oh boy, oh boy. It's April 3rd today. I never do these on the front day of the month, on the first day of the month, because seemingly, almost like clockwork, it's always in the first couple of days of the month that something wild happens. And it's happened. The agenda today, I generally have a number of topics to go through, but I've been quite busy as of this morning as dealing with the fallout and equally and inversely the opportunity set that's been created by what will go down as Liberation Day. So President Donald Trump gave a nice big speech last night talking about global tariffs and really shook things up, sending the markets reeling. This has been, a very knee-jerk reaction, definitely a worst-case scenario into the marketplace. So, go through kind of some of the talking points. So it's at least I don't have to talk about COVID anymore. Now we get to talk or Russia, Ukraine, and now it's tariff world. And I was very clear in last month's podcast that tariffs are going to really set the narrative for this next market cycle. So the breaking news is Trump's global tariff shakeup, sends markets reeling. So in a move that sent shockwaves, through global markets, President Trump has announced sweeping new tariffs, marking one of the most aggressive trade policies in recent history. Dubbed the 20% weighted global tariff, this policy is set to reshape international trade dynamics and has already triggered significant market reactions. Starting this Saturday, April 5th, the U.S. will impose a minimum 10% tariff on all trading partners worldwide. I just want you to understand, what is a tariff? A tariff is just a tax, and so anything coming into the U.S. from any country in the world is going to have a tax payable on it. Now, that tax is absorbed in two ways. It either pushes cost of goods higher for the consumer or the purchaser or end user of that product, or reduction in margin if there's price inelasticity of that product. So let me frame it in two ways. If it's an inelastic price, meaning it's not really bendable, like if the consumer, the manufacturer that uses it as an input, has no ability to pass those costs on to its customers and stands firm, the exporting country would be paying that tax and receiving less for their product, putting pressure on themselves. It's an incredible way for the government to collect money, but this will have a massive impact on costs and on consumer prices and on profitabilities for manufacturers, companies that maintain that utilize the benefits of global trade in manufacturing and production. This is significant. So the tariff breakdowns, I talked about the minimum 10% trade on all trading partners worldwide, but the policy doesn't stop there. Beginning April 9th, additional reciprocal duties will target about 60 countries, with China facing a staggering 34% tariff and the European Union seeing a 20% hike. Notably, Canada and Mexico remain under the existing 25% tariff under USMCA good compliant goods still exempt. So Canada, it's just absolutely wild. Like, I'm just looking at the TV, Switzerland 30%, Philippines 17. This is pretty wild. This puts an absolute shock into global supply chains. But I'll kind of get to a couple punchlines, Andy, there. And I hope I don't want to just beat the horse and talk about tariffs, about how bad they are. I just kind of want to set the table for what's going on. Analysts estimate that these measures collectively amount for about a 20% weighted global tariff, essentially the worst case scenario that many on Wall Street had feared. The market fallout, this is as of yesterday, the announcement had already rattled financial markets. Overnight, the S&P futures had dropped by over 2%, signaling unease, and the 10-year U.S. Treasury had fallen by 7 basis points to 4.13%, reflecting a flight to safety. So money's flying into treasuries right now. Meanwhile, the Canadian dollar has strengthened, with Canada, U.S. moving above 70 cents. So the dollar basket is weakening. What's next? The implications of these policies are vast, and economists warn of potential inflationary pressures as import costs rise, which could strain both businesses and consumers. On the geopolitical front, retaliatory measures from affected countries could escalate into a full-blown trade war, further destabilizing global markets. Don't panic yet. For Canada and Mexico, the lack of new tariffs might seem like reprieve, but the existing duties continue to weigh heavily on industries reliant on cross-border trade. So, final thoughts on this part of this commentary is as the world braces for the implementation of these tariffs, the question remains, will this strategy bolster U.S. manufacturing and reduce trade deficits as the administration claims, or will it backfire, leading to economic and diplomatic fallout? Time will tell here. So listen, there's some stocks that are absolutely tanking today. Restoration Hardware is down almost 40%. Why? Well, they make their products overseas, and margins will get compressed to near zero unless they can push their prices. Their Q4 earnings came out, and their revenue and guidance were missed. Their fiscal 2025 guidance came in very much below expectations, and analyst takeaways cited concerns around outside tariff exposure, excess inventory, elevated leverage, negative free cash flow, and uncertain consumer sentiment. So, shockingly, this company isn't making money considering what they charge for furniture. But I thought that was pretty wild for a one-day swing. Big tech stocks are getting hammered. I'm pull up my, Quest trusty trading machine. Amazon's down almost 8%, Apple's down 9%, Google down 3.4%, Microsoft's down to shade of 1.5%. The triple Qs, the Nasdaq exchange is down 4.7%, was down over 5% at one point. Facebook or Meta is down almost 7%. Across the board, some significant moves. Oil field services stocks down over 10%, on the day. Tesla down 5%. This is, JP Morgan down 5%. Like it's an absolute, I'm going to call it it's not a bloodbath. Like a bloodbath is if you had the time and monetize your whole portfolio today. That would have sucked. You should have done it yesterday. But, we said this year would be fraught with volatility. And, for certain, we have not got that wrong. So we talked about the Magnificent Seven and tilting really not away and short the sector, but making sure we had equal weight and more of a value tilt to portfolios. The Magnificent Seven has taken a hit, through a very rough start all the way through 2025. Since the beginning of the year, Tesla leading losses of 35% year to date. Nvidia and Google or Alphabet both down around 18% on the year. And the recent tariff announcements from President Trump have added further pressure, particularly on tech companies relying on global supply chains. So, Q1 2025 market review and analyzing the impacts of tariffs and geopolitical dynamics. If Q1 was a movie, it would probably be another installment of the Fast and the Furious franchise. And so many unanswered questions surrounding potential tariffs on Canada, Mexico, China, Europe have indeed come fast and furious, leading to much uncertainty and volatility in the marketplace. So what happened on Liberation Day? We received a bit of clarity. This baseline tariff of 10% on all countries, as I discussed, goes into effect. And in some cases, it's significantly worse. Like Vietnam is seeing a tariff of 46%. It's effectively shuts down their economies. But it's not over yet. And I just want to kind of get to why, on that. And there's, it doesn't mean the world is over. Listen, of note, Canada and Mexico, as I said, nothing additional has come in yet. This is kind of like the weather in Calgary or the weather in Scotland. Kind of says, if you don't like the weather, wait 5 minutes. And it's in that sentiment that many investors can relate to in a light of the current trading environments. The Trump administration has indicated that all these tariffs are not set in stone and depend on tariff policies of these countries moving forward. So this is a massive saber rattling. The Canadian market's down to 1.9% today. Vietnam's down almost 10. China's down their large cap index only 1. Mexico had been pricing in such a worst case scenario. The market's actually up today. But these aren't laws. These are massive saber rattlings of the strongest and biggest economy in the world. and people have to take notice, and countries will choose to fight or fall in line. And it's not a fight I'd want to pick. Canada, I think Canada's going to be okay on this. Again, I'm supposed to keep my politics out of this. Lots going to be determined here, coming up very quickly. But you just remember is that if you said X energy or not including energy, the U.S. does run a trade surplus, into Canada by about $33 billion, and I think about 8 million US jobs are reliant on oil flowing into the US market from Canada. Anything that's stamped and that's made in America is reliant on Canadian energy to be made and manufactured. So while in protectionism and nationalism and populism, Trump wants to make America great again and bolster manufacturing and the job market. He has to be cautious about cutting off the supply, the blood supply of what's needed. That being said, he could just invade us and take it all anyway. And maybe we never have to debate whether we should be the 51st state or not. I say that tongue in cheek, guys. And do I have a position? Yes, but I think it's like having a position in a round of aliens are real. The odds of us ever really knowing and it ever really happening are so low. I don't think we need to kind of ruin Thanksgiving or Easter dinner, and have these big debates. But the heightened sensitivity to this geopolitical landscape is reflected in the recent spike in the Global Economic Policy Uncertainty Index. It's called the GPU, which tracks the frequency of mentions of certain words and terms that are used to describe and explain economic policy. So it's no coincidence that the VIX, the market's go-to index to gauge market volatility, is strongly correlated with GPU. After 2 years of very limited volatility, barring a brief spell last summer's, investors' appetite for risk assets has decreased. After 2 years of just top rate performance in the equity markets, we suffer into a period of volatility, which we've been calling for and expecting, and people kind of want to panic, because they're just not used to it. So the acquiescence of being kind of slapped around a lot kind of made a bit of sense. It's sense to me, so to speak. But here we go. Let's just talk about this. All of these, after kind of like these routes, and we see this influxed, cause for volatility. What do we do that? Well, my inbox is filled with, hold the line imageries and the benefits of staying invested over the long term and why averaging down makes sense, and all of these like little quibs that the big banks fling around to their advisors to calm down their clients. We always said we were invested in people, process, and anchored in philosophy. And today's just another day. And I believe that brings opportunities. Positionings of portfolios have been tilted as ways that we're not completely out, but we are not overexposed to the sectors and parts of the economy that are getting throttled today. On the fixed income side, there are signs that the negative correlation between stocks and bonds may be strengthening. North American fixed income is at a relatively positive quarter, so that's a good thing. The more pragmatic parts of being balanced and having some discipline in your investment strategy is finally working, which we didn't see in the kind of last chaos of the marketplace. So it feels like I'm a little bit repeating myself. But I guess it's because I am. But some messages are worth repeating. In periods of uncertainty, investors should ask themselves, whether the situation is likely to be disruptive or destructive in nature. And we believe the current backdrop is more likely to be disruptive, like many other geopolitical developments that we've experienced in the past. Policymakers may be planning to use tariffs as a tool in future trade negotiations, which would be Trump 101. And in my view, while it could be part of an effort to secure leverage in eventual trade talks with Canada, this may not be so straightforward. So, I highlight three critical areas that help support a strong argument in Canada's favor. We've got the auto industry, oil, and potash. A car can cross the U.S. Canada and or the U.S. Mexico border as often as 8 times throughout the manufacturing process. According to reports, tariffs could cause car prices to increase by up to $12,000 on some models. Canada exports roughly 1.5 million cars to the U.S., building a car manufacturing capacity isn't just a capitally intensive undertaking. It also takes time, and the process is likely to take years and may lead to disruptions in the interim. And so, reports suggesting that if U.S. automakers were to move manufacturing activities back to the U.S., it would likely lead to higher prices, and the long-term labor costs could increase 10%, where light vehicle sales may decline by the same percentage. So careful about what jobs you want to bring home and what things you want to do. Oil, many U.S. refineries are designed to process Canada's heavy crude. Western Canadian Select, or WCS, as many of you know it. Of the 130 U.S. refineries, 25 of them use Canada's WCS, roughly 20%. If they went offline, it's reasonable to assume that U.S. consumers would see a sharp increase in gasoline prices. 15 years ago today, about 140,000 barrels of crude oil made their way to the United States. Today, that number is closer to 450,000 barrels a day because of the improved pipeline infrastructure. Oil transportation is much less efficient for oil imported from outside North America. And potash. Canada is the world's biggest producer of potash, a key ingredient in fertilizers used in crop farming, followed by Russia, Belarus, and China. The United States, as it happens, imports 85% of its potash from Canada. Potash production in Russia and Belarus has fallen in the past years due to geopolitical events and a development that may make it challenging for U.S. farmers to find alternative viable sources of potash in the short term, which could translate into higher prices for U.S. consumers. So listen, guys, we believe that the Trump administration judges its performance by the health of the U.S. economy and the stock market, and chances are that at some point the administration will seek to negotiate a solution with their counterparts. What will that take? A sustained pullback in the stock market, a bear market? It's impossible to know. One thing is clear to us, however, is that at the end of the quarter, we're not near crisis levels yet. Stock market corrections are both very common, also very difficult to predict. Since 1980, the likelihood of and that's by the way the year I was born, is the likelihood of the S&P index slipping into correction territory, which is a drop of 10% or more within a calendar year, is higher than 50%. Almost, yeah. And the average market retracement amid a sell-off in any given year, 14%. So the broad context against the eye-catching data is that the market has historically stayed in the positive column roughly 78% of the time in the calendar year, posting average return of 10%. So we don't use these things to panic. We use these things pragmatically, tactically, in a disciplined fashion to deploy capital and rebalance portfolios into doing that. So, policy uncertainty is likely going to remain heightened in the near term. Outbursts of market volatility will likely continue. So, what should investors do in time like this? My response, once again, may sound familiar and potentially a little boring. In certain times, I believe that investors should focus on solutions that are more targeted to downside protection than trying to capture upside risk. So, whether you're at the height of the storm, it can be difficult to remember that sunny days are just around the corner. Storms, however, do end. What's important is to remain calm until they do. So, some of the I'm gonna probably skip. Look, I see a few more numbers. Nike's down 13%. Obviously, like input costs out of China are going to be massive. American Express is down almost 10. Apple, like, it's definitely going to go down as one of the sharper sell-offs that I've seen in my career in a single day. But we're seeing the bottoms starting to. They feel like they're building. I have this long list of retaliatory actions and countermeasures that are on their way, and I'll address a couple of them because it definitely kind of makes you feel like that's the concern, where people are going to react and try to pick a fight with their big brother. Probably a dangerous thing to do, especially when your big brother's Donald Trump. Australia, Prime Minister Anthony Albanese said his government will try to negotiate with the U.S., but won't join a race to the bottom by retaliating. Smart move, well done. Brazil said it's considering its options for a response, including through the World Trade Organization, where countries can log disputes. Brazil's Congress passed a bill letting the government respond to foreign tariffs on its goods. Sounds like kind of like a soccer argument, people faking, pretending to fall over when someone bumps them. Very Brazil-like, I guess. Carney, in Canada, Carney's become he's the puppet master, for sure today. But Carney said Canada would introduce unspecified countermeasures on top of earlier retaliation, whatever. Beijing is saying it's going to take countermeasures, but didn't specify. Like no one really knows what they're going to do. Japan is going to pledge support for its affected domestic businesses and urge the U.S. to review its measures. So I think there's going to be a lot of people saying, "Hey, Donald, chill out, man. Like I get it. We know you're angry. We know you want your pound of flesh paid for access to your consumers, but careful what you do here because you're going to hurt your consumers too." So it's as bad as you've heard, um, but there's always time. Currencies are in flux today. The trade weighted U.S. dollar has been hit very hard today, down almost 1.5%. The euro, the yen, the franc, and Scandinavian currencies are at the top of the overnight league tables, all with all registering bilateral gains. So kind of a flight to some safer currencies, right now, and even Canada was up 70 basis points. So the facts. The U.S. We talked about the tariffs. Countries running large trade surpluses are getting extra hit hard. Canada, U.S. kind of under the radar-ish today, except for the comprehensive tariffs. And now we just kind of like march on. So I have a million other things about what this could look like. I think the implication here is that the Fed could be slower to ease further from here. So when we look at SOFR, kind of overnight lending rates immediately after yesterday's announcements, would suggest that the market's thinking the Fed will be more aggressive with rate cuts given the risks for growth. But we don't see that happening until we see weakness in real economic data. Because it's not there. The job market remains bust. Corporate balance sheets, corporate profits remain robust. So stock market's down today, but so far so good. Just volatility, on the horizon. So it also means probably in Canada is a lock to keep rates on hold. At the April meeting now, and just kind of hit the pause a little bit, on further rate cuts. On the equities, we're focusing on low volatility equity strategies and diversifying into markets where fiscal space remains ample to address trade shock. Continue to prefer U.S. equity sectors that are sheltered from trade war, healthcare, utilities, etc. Given the risk of stagflation, the theme and like these things taking root, we're long commodities and infrastructure. Energy's done well so far, and we envisage momentum continuing there. And longer term takeaways. It's better than expected or in line or worst case scenario. And it's just remember, we're talking about the hub of the world's financial system shifting from a trade model that emphasized low barriers to a far more protectionist one. For instance, assuming our math is right, the US now has the same average tariff rate as Iran, Sudan, and Algeria. How is that not bad for global growth going forward? So it's a shock today because, Big Orange Man said mean things. But there'll be negotiations in and around it, and Trump will then run around and tell everyone how good of a job he did, and he probably will. He's got the biggest saber to rattle, and he's going to be met with pleas and tears and accommodations. So we got to be cautious on 2025. The U.S. economy has averaged 2.5% annualized quarterly growth over the past 3 years. I doubt that's the case this year if tariffs are here to stay. That is probably more, if anyone is still listening, that's a long batch of tariff talk. As markets are attempting to assess and price in the implications of widening trade war, marked by escalating rounds of tariffs and reciprocal tariffs and retaliatory tariffs. We just got to be, we got to be cautious about what those impacts, how they'll translate and erase much of the year's projected earnings growth. So, just remain cautious but constructive and take advantage of massive swings in equity prices to deploy capital tactically. It's kind of it for me today. I didn't want to hit, and I'm sorry for my laid back nature. I'm working out of my office in Toronto here, and I don't know if it's a hangover of April Fool's joke, but it's probably about 90 degrees in here. I still have my pants on, but it's debatable. And at the end of the day, it is like blistering hot. And I think I brought Calgary's weather here. It was blizzarding yesterday, freezing cold, raining this morning, and now it's sunny and beautiful. So sorry for my Toronto colleagues to bring some of the spastic weather from out west out here, but here we are. Like anything, guys, thank you so much for your time, your attention, and the ongoing trust. And to be considered a private client of MLD. Apologies, my phone ringer was on. If you have any questions or concerns or comments, feel free to reach out. If there's someone near and dear to you, a friend, a family member, that doesn't have the benefit of having a proactive kind of outreach platform to understand and make sense of what's currently going on in the marketplace, forward on the podcast or my quarterly notes that'll be coming out, and feel free to leverage your relationship with us, because if someone's important to you, by default, that makes them important to us. So if someone is panicking or needs a second opinion on kind of what to do and how to navigate the current dynamic, feel free to introduce us. It's the greatest compliment we can receive. Thank you so much again. I look forward to speaking with many of you. As always, again, feel free to reach out with any comments or questions, and have an amazing April, guys. Take care.